Property investing rules of thumb that everybody should know. The 1%, the 50%, and the 70%. There are some rules of thumb that can help investors quickly scan through deals to make a good, educated guess on whether or not to pursue them. These rules of thumb are not to be hard and fast rules. They simply assist an investor to get a quick and dirty understanding on some of the variable metrics. Always do a proper analysis, but regardless, these rules of thumb can come in handy and save you from analyzing every single deal that comes across. Hi Legacy Brothers, I'm Ekow, and in this video, I've outlined the most common real estate math rule of thumbs so you can begin practicing them in your own analysis of your properties. Don't forget to smash the like button so that together we can get this video to spread to other people and hopefully help them as well. Let's go! First, the 1% rule is one of the most common rules of thumbs used by rental property investors. This rule of thumb looks at the monthly rental divided by the value of the property in a percentage form. For example, if the property rents for $2,000 a month and the value of the property is $200,000, then $2,000 divided by $200,000 is 1%. In this example, the property does meet the 1% rule. Now, what if the property rents for $2,000 a month but it's worth 120,000 rand? Well, 2,000 divided by 120,000 equal 1.67%. Alright, so you get how it works, right? But what does that mean? Well, the 1% rule gives you a quick and dirty view on whether or not your property will produce positive cash flow. And of course, this is just a rule of thumb. It isn't always precise, but generally speaking, the higher the percentage, the better the cash flow. That also greatly depends on location, price, and how much the expenses are on the property. But the rule of thumb can help an investor make some decision on whether or not to pursue a certain property. While the 1% rule can help you get a go or no-go decision on looking further into a rental property, it does not really tell us how much cash flow we might expect. For that, investors often rely on the 50% rule of thumb. The 50% rule of thumb states that, on average and over time, half of the income in a property is spent on operating expenses. This begs the question, what are operating expenses? Operating expenses are all the expenses involved in running a rental property except the loan payment. So it includes taxes, insurance, utilities, repairs, vacancy, and other stuff that takes money out of the landlord's pocket every single month. The 50% rule can help an investor quickly estimate the cash flow for rental property because it combines all those expenses into one easy number, half. For example, imagine a property rents for 4,000 rand a month. The 50% rule says half of this, 2,000 will be spent on expenses. This means that we are left with 2,000 bucks, but now we need to make the mortgage payment. So with that 2,000 left, let's say the mortgage is 1,200. So we have 800 bucks left in cash flow. That remaining 800 is what you can estimate over time on average to get as a monthly cash flow. Of course, that 50% estimate on operating expenses can vary depending on the property. In some areas, taxes and insurance might be really high, but in other areas, that might be much lower. While inherent weaknesses do exist, the 50% rule does have value. The 50% rule helps keep real estate investors in check and to remind us that there are a lot of expenses that over time add up. Onto the final rule of thumb, the 70% rule. The 70% rule states that the most you should pay for a potential flip is 70% of the after repair value, like what it will sell for when it is fixed up minus the repair cost. For example, if a property sells for 400k all fixed up and the property needed 50,000 worth of work to get there, then 400,000 times 70% is 280,000 minus 50,000 and you are left with 230,000. According to the 70% rule, the most someone should pay for that property is 230,000. But of course, there are problems with the 70% rule. This 70% rule assumes that 30% of the after repair value, the ARV, is going to be spent on the holding cost, the closing cost, on the buying side, the selling side, commission, taxes, attorney's fees, and the flipper's profit and any other charges that come up during the deal. This works well in some markets, but it has some severe limitations. If you want to dive deeper into this, then book my free consultation at PropertyAskEkow.com. Be a legacy builder, smash the like button, and don't forget to subscribe. Each one, teach one. Peace. Be a legacy builder, and don't forget to subscribe. Cheers.